life insurance dividend rates in the 1980s, 8%, 11%, 12%, a lot higher dividends than they are today. Today, we're hovering around a 6% dividend. Well, as inflation goes up and we see interest rates go up, historically speaking, so also have life insurance dividend rates, the money that they pay out to us as policyholders that gets reinvested back into our cash value to grow cash value more rapidly. The point here, we have been for over the last decade in a very low interest rate environment. So when we look at the IBC numbers, in my opinion, they're very conservative. We should see dividends go up over time, which can help hedge against some of this inflation.
Yeah, I think that's a point you've made in the past, Barry, and we've talked about a little bit. Despite the mixed bag of interest rates for many people going up, it's a little bit exciting to talk about it because the bottom line is that we've been illustrating policies and demonstrating the benefits in a completely flat interest rate environment. And when Nelson Nash originated the concept, which I think we'll get into, it was a high interest rate environment. So that only improves the picture, I think, is the point you're making.
Correct. Yeah. Looking into the future, I believe we're really going to see even better policies, although they're fantastic today. So I'm really optimistic about the future.
Social Security trouble seems to be an ongoing question mark at the federal level as to how Social Security is going to play out.
Yeah, and I want to pull up this recent article by CBS. So CBS News did a story, and many other news outlets did as well, about the Social Security benefits facing reduction a year earlier than they had expected. So the details here, Social Security and Medicare, the government's two biggest benefit programs, remain under intense financial pressure with the retirement of millions of baby boomers and a devastating pandemic. It says Social Security will be unable to pay full benefits starting in 2034. That's scary for a lot of people. So what can be done about that?
Certainly is scary. I think about my folks who are both, my mom's going to be 80 this year, and they're certainly relying on Social Security. I mean, they have other assets, but Social Security has become a staple for many in retirement. Definitely, there's planning to be considered around that.
Yeah. And the retirement gamble. This is a story done by Frontline, the retirement gamble, and the tagline that the retirement gamble raises troubling questions about how America's financial institutions protect our retirement savings.
Right. So, Barry, you've often talked about 401ks and dove into some depth looking at the issues there. Talked to a little bit of past webinars about the originator of the 401k and of having some reflection and concerns after the fact. That's something folks should be aware of. Of course, volatility of the markets. I link the retirement gamble and the 401k together in many ways, just from the standpoint that's what most people rely upon. If you just did your taxes not too long ago, I'm sure your tax advisor recommended that you max out your 401k. And these are all things to maybe open some discussion about.
Yeah, let's talk about some of this. So you mentioned 401ks, IRAs. Yes, CPAs and tax advisors say, hey, put a lot of money into those qualified plans because it's tax deferred money. What they're not sharing with their clients is it's a ticking time bomb. When you take the money out, chances are you'll pay more tax on it in the future as compared to just paying the tax today. We're recommending and suggesting maybe don't put all of your money into 401ks and IRAs. By having an infinite banking plan, it's going to allow you to grow money guaranteed and tax-free if done correctly. But a 401k or an IRA is not a tax savings, it's a tax deferral.
For many of you listening, we do some consulting, sometimes with higher net worth folks that have businesses. And Barry, what's one of the things that often comes up? It's how do I unwind how much I put into this 401k? So when you say deferral, there's some real things to be considered.
Yeah, it's real life, Steve, and not even to mention market volatility. What if you were planning on retiring in 08 or 09 or 2010, but with the market crash of 08, a lot of those people had to go back to work for a decade because they lost 20, 30, 40% of their portfolio. That volatility, that uncertainty really causes a lot of people sleepless nights.
Mm-hmm.
And
Mm-hmm.
I don't like to see someone just crossing their fingers and hoping for a good outcome. With the infinite banking policies, these high cash value whole life policies, because they have guarantees, people do now have predictability in their portfolio.
Right. And that's really the swap that people sometimes need to make. You're swapping from an insecure asset that can go up and down and take years to recover versus something that has got predictable gains. And I know we're going to talk about that. In addition to getting the tax issue resolved and then, having tax advantages down the road.
Yeah. And you mentioned Ted Benna. He's known as the father of the 401k. And he's come out and said repeatedly that he created a monster, that the intent for which he created it has been completely taken advantage of by Wall Street, that most people shouldn't be investing in a 401k because of the high fees, the market volatility, the tax deferral, et cetera. But we'll wrap up some of these updates and changes with the final one, and US debt. We're going to go to a real-time feed from usdebtclock.org. And there's two numbers we're going to look at here. The first one is in the top left-hand corner, which is US national debt. Now, recently we crossed $30 trillion of US debt, Steve. And, just to fathom $1 trillion is hard to do, but 30 trillion, it's near impossible. It'll never get paid for, and it continues to escalate by millions and millions every day. But the other number that's really concerning is this number down here called US unfunded liabilities. It's almost 170 trillion. Well, what does that mean? It means that the US government is on the hook to pay out $170 trillion. This is Social Security, Medicare, Medicaid, government programs. I mean, there's hundreds of them. Well, not only can you not take care of 30 trillion in debt, you can't take care of 170 trillion in unfunded liabilities. But what they're trying to do is get more of our money through taxation. And as taxes increase, this is another reason why people may want to seriously reconsider tax deferral. Because if taxes go up and you weren't planning on that, you could see much more of your nest egg eroded by higher taxation.
Kind of lends itself to think about the power of just this steady growth, tax advantages, everything that we're going to talk about. When you look at these scenarios, you think it starts to really make sense. And this is what we hope people listening to this will kind of click, that there's just a lot of factors why IBC in general and the current climate makes sense.
Yeah. So overall, there's no control in the stock market. There's tax deferral. We want people to be in control of their money, Steve. We want people to have predictability. And the benefits of infinite banking really are endless. But the main points we talk about today, guaranteed growth, access to liquid cash, tax-free use of money if done correctly. By adding infinite banking to your portfolio, I believe it enhances your overall portfolio. Most people, Steve, don't have tax-free money. If you consider taxable, tax deferred, and tax-free, if you were to ask someone, well, what bucket of money do you like best? 10 out of 10 people tell you they like tax-free. But when you ask them, where's most of their money? It is tax deferred. It is in the stock market. It is in the 401k. It is in the IRA, mutual funds. So they're dealing with all this volatility. They don't know exactly what their future is going to hold, but by adding infinite banking, now they've got this slow, steady growth. It's the tortoise and hare analogy, right? Over time, if you can earn a 4 to 5% tax-free return every year, that could compound to be much greater than what you're putting in a 401k or an IRA with extreme volatility.
Yeah, and there are so many things that we could talk about. The continuous compounding, the way that market returns are often talked about that are very generous to the markets. You talk about these average returns over 20, 30 years. So those are all financial things to consider. But my planning side really kicks in when you talk like this, Barry, because, I think about folks having a safe bucket, having at least part of their portfolio that is tax-free and predictable to underpin the rest of it. That's a powerful thing that people can consider, I think.
Yeah. Again, infinite banking can help protect you against that future uncertainty. Well, what is infinite banking? Nelson Nash created the concept in the 80s. It is a uniquely designed, properly structured whole life, high cash value insurance policy with a participating dividend paying mutual or fraternal life insurance company. It's a way for people to become their own bank by taking control of the banking function in their lives. And Nelson wrote a book called Becoming Your Own Banker, which was published in 2008. We highly recommend that people read it. We want to be clear. High cash value whole life insurance. There are other types of life insurance products out there that we don't recommend. It must be high cash value whole life, and there are reasons for that, like no increasing insurance costs, guarantees, etc.
Right now, Barry, and even on top of that, we talk a lot about mutual companies versus stock companies. There's a lot of exciting things to cherish, in my opinion, about mutual companies.
Yeah, and we like mutual companies and only use mutual companies for infinite banking because they pay dividends, and those dividends come back to us as policyholders. We'll talk more about dividends coming up, but that's a key point. If you have a life insurance policy with a stock company, you don't get the dividends. Those dividends go back to stockholders and investors, not you as a policyholder.
We highly recommend picking up the book. Understand that it was written in a high interest rate climate. Policies and the economic environment has evolved quite a bit since then. So just be aware of that as you're reading it.
And I tell people I work with that in the 5th edition, written in 2008, the illustration numbers that he uses in the book, they're high because we're not in that environment today.
Right.
Infinite banking, or IBC, is also known as Bank on Yourself, LIRP, which is life insurance retirement plan, cash flow banking, a wealth maximization account, a 770 account, private family banking. There's a lot of names for infinite banking, but it doesn't mean that it's all the same. You have to go back to that criteria we outlined before, that it must be dividend paying, mutual insurance company, whole life policy. Those key pieces are really important when you're setting up an infinite banking policy.
Yep. We want to talk about expertise. There's a lot of names and a lot of people out there. And so when folks are looking, you might get a lot of different information. You want to have somebody that focuses on this and obviously is able to shop companies and able to get the design and strategy that's needed.
Great segue, because the goal for a properly structured infinite banking policy, Steve, is low death benefit. We want the death benefit to be as low as possible and maximize the cash value, to have the cash value as high as possible.
It's sort of turning design of a traditional whole life policy on its head, because that traditional design is focused strictly on death benefit, correct?
That's correct.
What they got wrong about IBC.
When we say they, we're talking about financial advisors that don't understand infinite banking or whole life insurance. We're talking about Wall Street and banks. We're talking about even the financial entertainers out there that are completely misled or unknowing about what a true infinite banking policy is.
I would say that you just have to be aware that it's a battle for dollars. I got into this area years ago because I crossed paths with someone that was designing these policies, and it was from a planning standpoint that I was fascinated with it. Then I found out more about the wealth building aspects. For many, it's a battle for dollars, and unfortunately for me, it feels disingenuous when people will say things like buy term and invest the difference. It's invest the difference in what? I guess, invest in a mutual fund, and then we could go and talk about that. We can talk about the fees. We can talk about a lot of different things. The reality of it is that that's dangerous, when you try to put out some soundbite like that, and you're not even looking at a person's specific circumstances, for one. For two, most of those kinds of beliefs are based upon a flawed idea of what infinite banking is about. Either they don't know anything about it or they got the wrong information. And usually it has to do with a traditionally designed policy that doesn't have high cash value in it. Barry, I don't know if you want to speak more to that, but it seems like that's where a lot of the confusion is when folks are just simply not educated about these policies in IBC.
Yeah, another group that would be categorized in that word they are other life insurance agents, which is peculiar. But there are life insurance agents out there selling IBC incorrectly. They're telling clients half truths, or they're selling them the wrong company, the wrong type of policy, which is really sad. We want to make sure that we're super transparent, giving clients multiple looks at different companies, letting them see their own numbers, and really sticking to the foundation of high cash value whole life with a mutual insurance company that pays dividends. We're going to talk about some of these myths and the modern truths. And one of those is recapturing policy loans and the payback of interest. There's a myth out there that you hear, oh, you take a policy loan and all the interest comes back to you. That isn't true.
Right.
When you take a policy loan, that interest goes to the insurance company. And we're going to go through a policy loan here in a few minutes. But there is a myth about that. So when you have someone tell you that you take a loan and you're earning all the interest, that isn't true.
Right. The company charges an interest rate that's fairly nominal when you really look at what other interest rates are out there. These loans are, for all practical purposes, fantastic. You can get them very quickly, very liquid, tax advantage. They're not looked at as income in any way. And you're able to utilize that money while your money keeps working. So, but the thing that you brought up is just that, and even in Nelson's original book, that was an area that needed some clarification, was just that, yes, there's a cost of capital there.
Yeah. So another myth you'll hear is that the life insurance company keeps your cash value. Now, in a traditional whole life policy, if you're just buying a death benefit and you're not focused on cash value, that traditional whole life policy does have cash value. When you pass away, it's the death benefit that's paid out. And usually in that type of policy, the death benefit has stayed level. It doesn't grow. In an infinite banking policy, and we'll look at some details here in a few minutes, the death benefit's growing. So we can't tell clients that you get your cash value, but what we can say is in most cases, you get a growing death benefit, which is going to be larger than your cash value.
Right. And to me, you've got two different buckets going on there. You've got your cash value that you can access during your lifetime. And then you've got this death benefit. And if you take out of the cash value, then it can reduce your death benefit, which logically makes sense. It would be similar to you had a piece of real estate and you were taking equity out of it during your lifetime. And then upon death, that real estate would have that equity that was taken out would have to be repaid, or it just wouldn't be included in the property, right? We do get a lot of questions about that.
Yeah. And the mutual insurance company, they are actively investing these premium dollars. They primarily are buying guaranteed corporate bonds, but they also have real estate. They do some commercial lending. They're making money on our money. When we're hearing that dividends are a return of premium, that we've overpaid premiums, that's only partially true. So these financial entertainers that say, oh, you're just getting your money back in the form of a dividend, they make it sound like the insurance companies are just stuffing your premium dollars under a mattress. That isn't true. They're making money. They're earning returns. They're growing our money. So the dividend, yes, it's a return of premium, which we actually want that definition by the IRS, because now those dividends reinvested back into cash value are tax-free. So we like that definition, but it's only a partial truth to say it's a return of premium. They are, in fact, investing our dollars. They are making money. They are profitable. Those dividends do come back to us, and we're able to participate in the profits of the company.
Right. So in a mutual company, the policyholders get to take advantage of all of the good decision making by their company, which comes back in the form of a dividend. We did have a comment on I believe it was YouTube the other day, and we responded basically what you're saying, Barry. This is the expertise of the company that rewards the policyholders. By that same logic, I suppose somebody could say that if a share of stock paid a dividend that you simply overpaid for the stock. Obviously not rational. We're on a search for truth, and this is one of those truths that we hope people can benefit from.
Yeah, and that's a great analogy, Steve. Thanks for bringing that up.
Mm-hmm.
How to capitalize on it and establish a plan.
Exciting. Barry, are you going to guide us into some of the nuts and bolts for people getting started?
You bet. So here we go. I've brought up my whiteboard. We're going to first talk about a properly structured policy. And as you listen to the webinar, the amount of premium that you put into a policy is up to you. I've got clients in 49 states across the country. I've done this for 22 years. And I have clients putting in $500 a month, and I've got clients putting in $400,000 a year. I generally recommend looking at about 10% of your gross income to put into a policy. You can go up to 25% and add lump sums in addition to that, but 10% is a good number. What I want you to be aware of is in a properly structured policy, there are some components here. The first being base premium. This is what's going to the whole life portion. We want the amount of premium going into base to be as low as possible. So we're going to put $1 sign here. We want your PUA, which is your paid up additions, to have the majority of your premium going there. The reason we overfund PUA is because, Steve, it grows cash value. The more you put into PUA, the better the policy.
And this is key for folks, right? Both from the standpoint of having the expertise needed to design the policy, but also making a distinction with traditional whole life designs, right? Because with a traditional policy, you would have all base, no PUA, and you would just be looking at death benefit.
Correct.
And under that model, it's going to take a while to build cash value. And this is where people get a key point where people get confused, because you're not going to be taking advantage of the tax benefits and all these things with the cash when it takes so long to build the cash value, right?
Right. And there is cash value growing in a traditional whole life policy, but it takes 20 to 25 years for that cash value to equalize what you've put in.
Right.
Cash value to grow much more rapidly, but there's one thing we've got to be aware of, and that is what's called the MEC limit. It stands for Modified Endowment Contract. We're going to fund PUA, paid up additions, right up to the MEC limit, but we're not going to cross it.
Yeah.
What's happening now is you're getting a maximized policy day one. And one of the ways that we raise the MEC limit is by adding a term insurance rider to the policy. So it is whole life, but we're blending a term rider on the policy for two things. One, it lowers your cost of insurance. Two, it raises that MEC limit so you can get all this extra cash into the policy.
Barry, why is there a MEC limit? I'm wondering if people are wondering that. There's an obvious reason, because this would be too good if you didn't have it, correct?
Yeah, it's actually the IRS's stamp of approval on these policies. They've come out and said that, yes, you can heavily overfund a whole life policy with extra cash value. But based on your death benefit amount, your MEC limit is determined. So a $10 million death benefit has a higher MEC limit. You can get a lot more cash into that versus a $1 million death benefit. All right, Steve, we're going to look at some real numbers. And today we're using Dwayne Johnson, The Rock, as our example. We're assuming he's 40 years old and that he's going to put $24,000 a year into a policy. In a traditional whole life policy that would be all base premium, there would be $0 of cash value in the policy. But if you notice on his cash value numbers, there's nearly $19,000 in first year cash value. So we see most of his premium going to cash, not to pay for life insurance.
Yeah, paid up additions in action.
Exactly. And that's why this policy is so powerful, because of the PUA and also because of the term insurance rider. In year one, he's getting a $539,000 death benefit, but he's only paying for $241,000 of actual whole life insurance out of pocket. That remaining portion is coming from an increasing death benefit based on dividends, but also the term insurance rider. And every year, that death benefit's growing. You can see year 15, it's grown to 1.3 million. But again, he only paid for 241,000 of whole life base premium. So that's really important from a planning side, like yourself as an estate attorney, for someone to have death benefit in their portfolio, because look, they can use this for legacy planning. They can use this for estate tax purposes. And if you look at what the wealthy have done in this country, the Rockefellers, the Kennedys, the Rothschilds, they've used permanent whole life insurance to perpetuate family wealth generationally.
Mm-hmm. Yeah, powerful stuff. So Barry, for those who are listening that maybe have a little more experience with this, a couple things that they might ask. Number one, like, how did you design this? This is an actual policy design. How did you design it? I know there's different figures out there when you talk about base versus paid up additions. There's probably 80-20, 90-10. And then the other thing is, how much term do you typically blend in, and what happens to the term? Does it drop off? So if you guys are either pretty experienced or starting to think about it, those are good things to know about your policy. What are your thoughts on that?
Yeah, this policy is designed at an 85-15. You hear things about a 90-10. A 90-10 design, meaning 90% of your premium goes to PUA and only 10% to base. Those policies look really good early on, but by the time you hit year 5, 6, 7, an 85-15 or an 80-20 will outperform it generally with higher cash value. So I'll show people I meet with several different companies, several different scenarios, and let them decide if it's more important for you to have higher early cash value, say years 1 through 5, as compared to higher later cash value, like years 6 forward. You would choose one company over the other. But for a lot of my clients, they're like, I'm looking at this as a retirement plan. I want as much income in retirement as possible. Let's look more mid to long term, which again, I like the 85-15 or 80-20 design for that.
Yeah, no, and I just want to give Barry some props here. If you are surfing around looking for information and somebody says, I do 90-10, that's like all they do, for example. Reason that I glean a lot from Barry is because of how he answered that question. There's going to be cases where maybe a 90-10 would be good, depending on the goals, right, Barry? In other cases, 85, the 85-15. So it's really case by case, and you need somebody to help determine that.
Yeah, and sometimes a 70-30 might be better for someone. So just as we can't say buy term insurance and invest the difference, or whole life is never good, like some of these financial entertainers say, we look at it on a case-by-case basis. What are your goals? What do you want? I don't want to put out a blanket statement and say always use a 90-10. That doesn't work for everybody.
Yep. Exactly. What about the other thing, Barry, with the term? People may think, well, if I got term, it's going to expire. How does that typically work within a blend policy?
Yeah, several ways. One, you could have it drop off after the 7th year. The Met guideline typically says you have to fund a policy at least 7 years and keep the term insurance on there for that long. In this particular policy, the term insurance is naturally reducing over time. And about year 30, it goes away. So it's kind of like a reducing term policy over that 30-year period. But there's a lot of options. Again, that's goal specific to someone, what they're wanting to accomplish. You might have someone that says, yep, I want the term gone. Starting year 8, I don't need the higher death benefit. Let's reduce it because I don't want any drag on the cash value. Or someone else that has, 4, 5, 6 kids might say, no, I want that term insurance on there. I want the higher death benefit, or I've got family history issues. I'm concerned that I might pass away prematurely. It's goal specific. So the options are there for someone to choose what they want done with the term insurance.
Awesome. One more question, Barry. I know people may be thinking, they're going to be wondering what company you're using. They're going to be thinking, how do you pick? How do we pick as a group? How do we pick companies? Any feedback on that and what folks should be thinking about?
It goes back to the slide earlier about what's absolutely necessary for infinite banking. It has to be a top mutual insurance company. The company we're looking at here is a 176-year-old company. They've never missed a single year of paying a dividend. All the companies that I use as an independent advisor have all been in business for 145 years plus. They're A plus rated. They've paid dividends. Those dividends come back to us as policyholders. They're reinvested back into cash value. So rest assured, I've done all the homework for our clients. I always am giving clients the best of the best companies in the entire industry.
Yeah, that's the key. And so this says non-guaranteed too, Barry, and people may be wondering about that.
Yep, so glad you brought that up. So I'm going to scroll up to the basic ledger. And the basic ledger now shows us the guaranteed values. This is a fully guaranteed whole life product. And you notice in the cash value under the guaranteed values that the values are always increasing. Doesn't matter if the client's 60, 80, 100, doesn't matter. The cash value is always going up because there are no increasing insurance costs on that base whole life premium. Unlike some other products out there like IUL, Indexed Universal Life, that does have increasing costs, these guarantees are always increasing.
Huge point that you just made, Barry. People need to understand that. These are fixed costs that you're looking at. This is not runaway costs. This is not what you've heard. You heard about IULs and some of the problems. This is a completely different ballgame. Those policies shift the risk over to you as the consumer. This is a completely company-based risk that you're looking at right here.
And I believe when you buy insurance, whether it's homeowners, auto insurance, life insurance, you really should be giving your risk to someone else. In an IUL, that isn't true. In whole life, yes, the insurance company is taking the risk and they give you a full guarantee. What I don't like about the guarantees, Steve, is they never include the dividend. So here we have a company that's paid dividend over 175 years. To show cash value never earning a dividend, in my opinion, is unrealistic, which is why we've been looking at the non-guaranteed values. So we're going to go back to that page where we were at. The reason the values are not guaranteed with the dividend is we don't know what the dividend will be from one year to the next. They've always paid it, but it can fluctuate from one year to the next.
And the companies, obviously, that are competing for business, they do tend to prioritize paying dividends.
That's a fair statement since they've paid dividends over 175 years, right?
Yep.
I like to show the cash value numbers with the dividend. And Steve, what's great about a dividend is once it's paid, it's locked in. It can never be taken from you. If you have a dividend paying stock and you have the dividends reinvested back into the stock and you lose value on the stock, let's say the stock price goes down, you could lose the dividend. Not in a whole life policy. Once the dividend is paid, it's locked in. So it's secure. It's that principal protection. It's that security of you locking in your gains. And notice what's happening over time. As the $24,000 a year is going in or $2,000 a month, the cash value is always increasing. And there comes a point where it increases by more than they're putting in. Matter of fact, that happened in year 4. There was $26,000 of increase, and this policy completely breaks even in about 5.5 years. Well, here's the play. Dwayne Johnson has funded this at $24,000 a year for 20 years. In year 21, he says, you know what? I don't want to put the $24,000 in anymore. I'm going to reduce to the minimum. And Steve, this is so cool. This is a flexible premium. There's another myth out there about whole life insurance that you have to pay the premium your whole life. That isn't true in an infinite banking policy. There's premium flexibility. So in any year, Dwayne could pay as high as $24,000, but he can also go as low as $4,600. And he can fund any amount in between that. So if there's some years he only wants to put in $18,000 or $12,000 or the minimum of $4,600, he has the complete flexibility to do that. No questions asked, and the policy stays in force.
Yeah, that's a fantastic point. I know from my own experience with my own policies and that there's a ton of flexibility with these paid up additions. You certainly aren't obligated to throw that 24,000 in, but you can, which is a beautiful thing.
And I'm even showing in this example what happens if he would stop funding. So age 66, premium outlay is zero. He's not putting any more money in, Steve. So at this point, his total contributions over that 25-year time frame would have added up to 503,000. His cash value is $1,084,000. And I want to remind everyone that's a tax-free number. Even after he's done funding, his cash value is growing 57,000 a year, 60,000 a year, right? He's not putting any more money. And then at some point he could decide to take income out of this, which we're going to talk about here in a few minutes.
So Barry, just speaking to what you just said, what would those numbers look like in an IRA? With the taxes added back on, I suppose it would look like 1.5 or something. In other words, it's more than what, if you're really used to looking at your IRA, this is a lot more because of the tax-free nature of it.
Correct. This policy as it sits right now has a net tax-free return of 4.85%. What would that have to be in an IRA? It would have to be 7.5% or higher if you've got a higher tax bracket. So to earn 7.5% every year in your IRA is impossible because there's market volatility.
Every year, right?
Every year, Steve, that's not even having a down year. So to earn 4.85% in a high cash value whole life policy, it's remarkable.
Yep. And that's where we talk about continuous true compounding. We actually have had other webinars that we've done on that.
And that 241,000 of actual whole life insurance that he purchased has now grown to 1.9 million at the age of 69. So if he were to pass away and he didn't have any outstanding loans, his family would get 1.95 million. So this goes to the question we asked earlier: does a life insurance company keep your cash value? Well, if you add up the 241,000 that he originally purchased with the 1.26 million, you're only at about 1.5, right? So we go here plus 241, 1.5. Well, when he passes away, what would his family get? They'd get 1.9. So they're getting more than the total cash value.
Cash value funding the death benefit.
Yeah. These infinite banking plans, because they're uniquely designed, they're much better than a traditional whole life policy. You get more bang for your buck. You get a growing death benefit. You have access to this liquid cash throughout your life. That's going to bring us to banking. And how do policy loans work? We're going to go back to the Dwayne Johnson illustration, and let's make an assumption. In year 3, he wants to take a loan for $50,000, and he can. He has $63,000 in cash value. The insurance companies generally allow you to borrow 90 to 95% of your total cash value. You can even do that in year 1 if you wanted to. I recommend waiting a couple years to let cash value build. So he's going to take a $50,000 loan, and our number here in total cash value is $63,000. I'm going to come back to the whiteboard and look at how a policy loan works. Here's his $63,000 in cash value. He wants to take a $50,000 loan, and let's say it's going to be for a down payment on real estate. When he takes the policy loan, Steve, the insurance company does give him a loan somewhere between 4 to 5%. And that interest is going back to the insurance company. However, the insurance company doesn't physically remove the $50,000 from his cash value. They put a lien against it. So what that means is his full $63,000 is still earning interest and dividends, even though he has a policy loan.
Right. And this is getting to the crux of infinite banking, right? And this is, I think, Barry, this is the most misunderstood and underappreciated aspect of high cash value life insurance. And this is why I think Nelson wrote the book. But people just don't get this. It took me a while. The bottom line is that where else can you have this asset where you can take cash, pay a nominal rate of interest, and have that money keep working inside of a policy. And we've written a lot of articles about this. You and I have talked about these things. We refer to that as the velocity of money. Keep your money moving. We talked about creating a financial arbitrage, because if you buy a piece of real estate with it, and not only do you get your dividends and your guaranteed policy growth, but you're also getting whatever you're doing on the real estate. And I know we're going to touch on this, but then when you pay back your policy loan, which is really part of the process, you're recapturing that money. This is going to turn your wealth building momentum on its head. I can confidently say, if a person can really understand this.
Yeah, you bring up so many valid points that if you look at what the wealthy do, they leverage their own assets. And
Yep.
This is a way of leveraging your infinite banking asset, that you can go buy real estate, you can invest in your business, whatever the case might be, to make other investments and make money there, while your infinite banking policy is still making money. And let's look at that detail. So I'm going to pull up a loan analysis calculator, and we're going to put in the $50,000 loan balance. And let's use the higher number, show people what's possible here. 5% interest rate. And because it's your own bank, you get to choose how you want to pay it back. Is it a 2-year loan? Is it a 20-year loan? Or is it a 40-year loan? It's really up to you. But let's show this amortized over a 10-year time frame, which is 120 months. And what that means is that you would make a monthly payment back of $530 a month. And that $530, Steve, is going to the insurance company. You're paying principal and you're paying interest back to the insurance company. I can't be more clear on it. That interest is going back to the insurance company. Yep. But what's happening over time is the balance of the loan is going down, so you're paying less interest over time. We call that principal reduction. Yep. And the total interest paid to the insurance company would be $13,639. So let's remember that.
And Barry, I'll just testify for a second. Having utilized policy loans for investing in different things, I mean, these are the best loans that I've ever had. I'll tell you that right now. I mean, it's flexible. You can decide whether you're going to pay back in lump sums. Maybe you have some good months in your business, you can pay back more. It's a very workable asset to be utilizing, loans from. And it's also easy to obtain from the company, no credit checks, things like that. So for real estate investors, fantastic, much preferable to trying to get a loan for a down payment and these kinds of things. Great resource.
Yep. And I'll add to that, besides no credit check, there's no application. And the insurance company, they don't question you, Steve. What do you need the money for? They don't care, because they're using your death benefit as collateral. And what's really important is that the principal reduction means you're paying less interest over time. So if this straight line represents the dollar amount of zero, you took the loan, but you're paying it back over time, which means you're paying less interest over time. And this is super important, because we're now going to make a comparison as to what was happening inside the policy to the $50,000. You took a $50,000 loan, but that full $50,000 is still earning interest and dividends in the policy. And to illustrate this, I want to pull up a future value calculator. We're going to put in the $50,000. Policy, in this case, 4.85%. So it's a little bit less than the 5, but guess what? It doesn't matter. Watch what happens. If we go the same 120 months, your 50,000 has grown to 81,129. That's a $31,000 difference. So in 10 years, you grew $31,000 in cash value on the same 50. And when we look at what you paid in interest compared to what your policy still earned on the 50, 31 minus 13,639, you still come out ahead a positive 17 grand. There's the power of infinite banking.
Yep. And that's without accounting for any, secondary investments or anything like that. And I know you've talked about that and touched on a lot of things in our real estate webinars, right? Where you then take that and factor in gains from other investments, and you've got these huge ROI differences there.
Yeah. And you mentioned the velocity of money. We want people understanding, what do banks do to make money? What do the wealthy people do to make money? This allows you to have some of those same financial principles in your portfolio.
So the policy loans, Barry, it's liquidity. And of course, when you take a policy loan, you mentioned that it's not taxed, right? It's
Correct.
Liquid cash that's not taxed and easy to obtain in a protected environment too. You know, we haven't talked much about asset protection, but of course you have that with life insurance.
Yeah.
In the state to state, that can vary a bit, but generally speaking.
Safe place to store cash. Most states protect you against creditors, lawsuits, bankruptcy. So not only are you getting the growth, you're getting the asset protection. And the power here is the compounding, Steve. You know, the interest was reducing because of principal reduction and paying off the loan. But your policy cash value, that 50,000, was still compounding every year. I didn't even calculate the 63,000 total cash value. If we had that 31,000 increase, would even be larger. But I wanted to show an apples to apples comparison. You want compound interest in your plan. If you look at the stock market and the volatility, you can't have compound interest there. You can only have true compound interest when you have a guarantee.
And, you know, there's a lot written out there about compound interest and the miracle of compound interest.
Steve, I love this next section because we're going to talk about income. So far, we've talked about all of the benefits of the policy, how to use the policy throughout your life. But what happens when you hit retirement, or whatever retirement means to you, and you now want to stop premiums, no more money going into the policy, but you want to begin taking income out of the policy? And just some quick scenarios. Okay, these are real life clients. Case study number one, a 31-year-old dentist client of mine, how he turns $875,000 into $2.5 million tax-free. Case study two is a 36-year-old real estate investor. He puts $282,000 into his IBC policy, and he's able to generate $825,000 of tax-free income. Case study number three, this is a 51-year-old business owner client of mine. He started late on his retirement, but at age 70, he'll be able to turn $700,000 into 2 times that amount, $1.4 million, completely tax-free. And by the way, if he passes away prematurely, there's still a death benefit that goes to his heirs. And even after he exhausts the $1.4 million, there's still death benefit that will go tax-free to heirs. And case study number 4 with Dwayne Johnson that we've been looking at, $24,000 a year going into a policy, and he pulls out a lot of tax-free income. We're going to go back to the Dwayne Johnson example, and now we're looking at income. $24,000 a year, cash value growth we see here. He's going to fund for 20 years, and then for only 5 years, Steve, he's going to put in the minimum. From age 61 to 65, he's going to put in the 4,600. But what happens at age 66? He's going to stop. No more money going in. Cash value is still growing, as we talked about earlier. And at age 68, he says, I'm going to start my tax-free income distribution. And he begins taking $75,000 a year in tax-free income. Why is it tax-free? Number one, and this is a general recommendation, you're first going to withdraw the amount of money that you put in. We call that basis. So he's going to take out the $503,000 first, and because he already paid tax on it, it's not taxable. Once he's exhausted the basis, then he starts taking policy loans, but he doesn't pay the loans back. And you said it earlier, Steve, loans are not taxable. So he's taking loans once his basis is exhausted.
So that's all part of the calculation here.
Correct. It is. 75,000 starting age 68, and I ran this through the age of 90.
So Barry, what would 75,000 be if it were coming out of an IRA in a, say, an average tax bracket?
Right. If someone's in an average tax bracket and they're all marginal, so let's say around 25%, he'd have to have about 110,000 in his IRA or stock market account, tax deferred, pay the tax to net 75,000. So what that means for someone in retirement, if they have an IBC plan, they don't have to take out as much money.
And here's the other thing. I mean, yes, the 75, if you're taking out from your basis, would it go to your taxable income? I guess that's the question.
If you're taking from basis, it's tax-free too, because you already paid tax on it.
So that's a key point, right? It's not even pushing the individual into a higher tax bracket.
That's right.
Which is one of the biggest problems with the, traditional retirement account is going to be that they have to take it out. Number one, they have to take out more to recognize the same amount of income, and it's going to push them into a higher tax bracket. So it's kind of a triple shot.
Yeah. This 75,000 a year, it's not reported to your CPA. It's not reported on your 1040 tax return. It really is tax-free money.
Yeah. For high net worth people in particular, but really for everybody, but particularly if a person has other income, this is enormous, because the people wrestle with the tax bracket that they're in, and they get to where they have to do these required minimum distributions. You've got this starting at 68. And if someone's got a traditional retirement account, they have to start taking distributions. Is it 72 and a half?
Yes, correct. And look, even
72.
if you don't need the money, you're forced to take out that required minimum distribution.
Yeah, and it's going to push the individual into a higher tax bracket.
It could.
Oftentimes, yeah.
And here we're using 75,000 consistently starting at age 68. But recognize if someone wanted to take out 50,000 one year, 80,000 the next year, they can. It's really up to them how they want to take it out, but they're not forced to take money out of this at the age of 72. There's no required minimum distribution here. But Steve, here's the punchline. Notice Dwayne Johnson put 503,000 into the policy. He's pulling out 75,000 a year for 23 years. Boom. He's taking out 1.72 million, 3 times more than the amount that he put in. And once he passes away at age 90, he's still leaving a $317,000 tax-free death benefit to his beneficiaries. It's huge.
Mm-hmm. I think so. And I also, for me, that is huge, because he basically, utilized this as a retirement plan. There's terminology out there again for this kind of a strategy, right, Barry? You got LIRP, which is life insurance retirement plan, among others. I do think that the point that we just touched on about income taxes is also enormous. If you think about the difference between having to recognize 120,000 in extra income versus taking the same amount and not recognizing it at all, that's a complete game changer. You're talking about a $200,000 swing right there.
And what we're suggesting and recommending to people, Steve, is they add infinite banking to their portfolio. Why? Because of all these benefits. They're not getting all these benefits in their traditional retirement accounts. So to really be diversified, you should have a guaranteed, safe, liquid, tax-free bucket of money in your portfolio.
Right. So Barry, even if you converted a portion of of that account, and then you come around to age 72, you may have a situation where you have to take 100,000 instead of 225, and yet you can still take that same amount that you converted earlier and not even have it recognized. So you can live very humbly from a tax standpoint and have probably a higher standard of living at that point. So,
perhaps, and it could even keep you in a lower tax bracket.
Yeah, which is a big deal when we're talking to these, a lot of people that have had businesses that had sold, have had high paying jobs. Obviously, this is powerful for the average person as well, because everybody gets concerned about taxes at a certain age. So,
yeah. For me personally, I own multiple policies myself, and I continue to add them throughout my life. I want as much tax-free income as possible. I want to be able to turn $500,000 or more into 1.7 million tax-free or more.
Mm,
I
powerful.
am not a fan of paying taxes, and having more tax-free buckets of money in my future, I think is going to be very important and very valuable. But I think if clients begin to recognize, people listening to the webinar today, you want to put as much money as you can into an infinite banking policy so you have a better tax-free future.
Right, Barry. And I will circle back to death benefit. The retirement account, trying to pass that to beneficiaries has become increasingly complicated over the years. So here you have this pile of money that can go tax-free from a policy. But if you try to pass your IRA, 401k, whatever to beneficiaries, now under what's called the Secure Act, they have to pay it out. The beneficiary has to pay it, all the proceeds out or recognize as income within 10 years. So they have required minimum distributions essentially, on that, whatever that is, that beneficiary IRA. So you've got complications down the line with those. And so this is a way to sort of exit that or limit those issues as they, they're certain to arise. So
really good point. Steve, we've hit on a lot of these ways to use infinite banking, loans for business and equipment purchases, real estate down payments and purchases, to buy assets and make other investments, capital preservation, that your money is safe and secure and guaranteed in a policy, pension maximization. I can actually show clients how you can take more money out of your pension if you have a permanent whole life death benefit. Collateral assignment, another thing you can use the death benefit for. You can walk into a bank, put your death benefit up as collateral and perhaps borrow more money. You're a more advantageous borrower with a high cash value whole life policy.
Sure. It's an asset on your balance sheet, right?
Yeah.
So
pay off higher interest rate debts. You see that loan rates today are around 4 to 5%. A lot of people have higher student loan rates, credit card debt, personal loans, right? All sorts of higher interest rates out there that you could use an IBC policy to pay off. My recommendation is to take loans to buy assets. That's first and foremost, but you can use a policy to pay off higher interest rates, tax-free retirement income that we have just shown, and on and on and on. The benefits really never end.
Barry, let me pick out one point. I personally, as an entrepreneurial person, have a soft spot for entrepreneurs. We've done a webinar recently on IBC for doctors, talk about business equipment inventory. Had a chiropractor friend mention to me that he had a financial person that was counseling him to cash in his cash value policy, which of course I questioned him on. I was bothered that he got that advice. I told him so. The thing of it is, when you consider everything that we've been talking about, I encourage folks to think the other way about it. Do more. You're buying assets. As a chiropractor, you're buying equipment. Think of all the ways that this powerful tool can be leveraged for somebody like that. So I just want to encourage folks to that end.
Yeah, very good. Well, social proof. A lot of you out there know these names, know these individuals, know these companies. The reason we believe social proof is so important is because there are a lot of people out there with high cash value life insurance policies that you're probably not even aware of. They don't talk about it. And most banks have these high cash value policies and they never talk about it. And there's a reason they have these policies. What I want to share are two quick real life scenarios, one with Chase Bank and the other with Wells Fargo. You're going to see on the FDIC website that they own billions of dollars of cash value life insurance. So we're doing this in real time. I'm going to pull up the FDIC website, and here's Wells Fargo. If you scroll down to line item number 41, life insurance assets, 19.5 billion.
And folks are going to wonder, how are they using it and that kind of thing, Barry? And you can say that probably a lot of it is for similar purposes, what we've talked about. Any thoughts on that for folks?
Yep. There's a slide I'm going to share on it. They're using it for the same reasons that we're using it. They want leverage. They want a safe, guaranteed asset. They want to be sure that their money is working for them as well. Here's Chase Bank, right on the FDIC website. This is all public information. They just never talk about it. 12.2 billion.
Mm.
Life insurance assets. Why they use it? Safe, liquid reserves. They put that money into high cash value whole life insurance. It's a better growth rate. Tax sheltered. It's liquid and accessible. They have it for key person protection, right?
Mm-hmm.
If they have a key person pass away, or if they're paying out a pension, that money is going to be recaptured by the bank or the institution in the form of the death benefit. And they're very high funding limits. In these infinite banking policies, you're not limited to, $6,000 a year in your Roth IRA or 19,500 in a 401k. You can put up to 25% of your income in it and add lump sums of cash on top of that. Again, we look at your numbers individually, but very high funding limits in a high cash value infinite banking policy.
Interesting. And people may have questions about that. So if someone's making $100,000 a year, technically then the benchmark to shoot for is 25,000. That's what you're saying.
Yeah. And if that's too high for them, they might say, well, let's look at 10,000. Let's look at 15,000. Right. We want it to be a very good fit financially for every person. We don't want anyone losing sleep over a premium payment, but also recognize the more money you put into a policy, the more cash you're going to have to use throughout your life, and the more tax-free money for income you'll have in retirement. The Wall Street Journal called this the tax shelter of the rich. We've talked about these multiple benefits over and over. We're creating wealth. We're using tax advantage planning, capital preservation, legacy planning, all the liquidity, the velocity of money, right? The benefits go on and on. And what's great about this, yes, it's life insurance. It's not called death insurance. These are living benefits, most living benefits that you have throughout your life. And Steve, we would invite people to learn more, that they can click the link to go to a quick questionnaire and learn more and look at their own numbers.
We welcome that. If you're at that point, you want to take a next step, you can access the calendar with just a few identifying questions, help Barry or whoever the team member is to get a better idea of your situation and get a personalized look with the illustrations, being customized for you. We invite you to do that. Thank you for joining us. Thank you, Barry.
You're welcome, Steve. Good to be with you.
Click the website link or button to take next steps to learn more.